So we did see stocks move up Friday amid optimism that, sure enough, September 17th, the US Fed will cut interest rates. And let's get more from Matt Orton, Chief Market Strategist at Raymond James Investment Management. Matt, thanks for coming on the show. You think Friday's reaction was a little overdone?
Hey, good morning, Andrew. Yeah, I think it was a little overdone given that, Powell certainly strongly indicated that we're going to have rate cuts in September. But beyond that, I think there's still a question mark with respect to balancing some of the uncertainties related to tariffs, as well as thinking through the actual level of economic weakness that might be there to necessitate rate cuts. So I certainly think that we're going to get a rate cut in September, but to see the degree of movement, especially in parts of the market where you haven't really seen earnings strength, so call that consumer discretionary, materials company, energy companies. Those were the strongest companies that rallied on Friday. That to me seems a bit overdone, and perhaps that's why we're seeing some of that fade this morning, and we're seeing more strength in the secular durable growers like information technology, communication services this morning, which to me are some of my longer term preferred areas of the market to be in.
So you reckon there has been something of a rotation out of tech companies? Bloomberg actually noting that some of the software companies like Adobe and Salesforce have suffered this year.
Yeah, tech certainly hasn't been a one-way story like it has been in the past. You've seen a lot of residual strength in semiconductors and the companies that are more exposed to the build-out of artificial intelligence. But the application-based companies in software, really outside of your Microsofts, at least in large cap software, they haven't been as strong. You've actually seen some meaningful weakness in a handful of companies. And I think part of that is reflective of the case that AI might take a little bit longer to actually build out. And also you've seen some latent weakness in cybersecurity, which I think is a miss. And there's certainly a lot of really interesting opportunities, especially in the cyberspace, where any CTO that I speak with is trying to find ways to make more investments and more aggressive investments and protecting and ring fencing their information architecture. So I think that can be a big growth area going forward. And it looks relatively cheap to where their earnings have actually been coming in. So I think it's set up to create a lot of opportunities across the board.
In particular in cybersecurity.
Yeah, cybersecurity to me does look very interesting right now, given its weakness relative not only to software, but the rest of information technology.
You reckon that the market has promised, though, even though investors are too optimistic in hoping for 2 rate cuts this year?
Yeah, Andrew, I think the probability of getting 2 rate cuts this year has certainly increased from where we were, say, on Monday of last week. But I think there's a lot of reasons to still be optimistic about this market. All-time highs tend to beget all-time highs. And when we look at what has really underpinned the strength of the market this year, it hasn't been just because the Federal Reserve is expected to cut interest rates. It's been because of earnings. The fundamentals are actually there. And I think a lot of investors have overlooked the residual strength, not only of the economy, but of the ability of the consumer to continue to keep this economy going, and also just how powerful the momentum is behind the build out of artificial intelligence and the fact that it doesn't just have to be exclusively information technology. The AI trade has touched sectors like industrials. You've seen incredible strength among electronic equipment companies. So there's a lot of different ways to play that. And to me, I encourage investors to lean into those themes, but across a wider basket of companies where you're seeing that earnings momentum really start to accelerate going forward as CapEx continues to increase in AI.
What about the trade war? There's a lot of noise, there's a lot of threats, and then things get delayed or even scaled back. Do tariffs factor into your investment playbook in a big way right now?
Yeah, it's a great question, Andrew, and one that a lot of clients have been asking really since March and then in April after Liberation Day. And I think tariffs do matter, but they matter more to specific sectors, and it matters to investor sentiment as well. I think the more we start to get certainty around where the average tariff rate is going to land, I think that helps enable the market, generally speaking, to continue to rise and lean into the earnings strength that we've seen. I think you have to look with an idiosyncratic lens, a very stock-specific lens, with respect to how tariffs are going to impact some of the more consumer-based companies. So we've been getting earnings over the past few weeks for a lot of the consumer names. Walmart last week I thought was actually pretty good, despite an earnings miss. They didn't really guide to earnings specifically, but you're seeing companies be able to handle tariffs in different ways, and I do think there's going to be a very bifurcated response to how these companies are able to pass through tariff increases. And that's one of the key reasons, Andrew, that I really don't like the consumer staples sector overall, because they cater more to the lower end consumer that has been under the most challenges with respect to wage growth, the impact of tariffs, and they have the least ability to increase prices going forward. So tariffs are going to impact them more than, say, some of the consumer discretion names like Lululemon or some of the luxury goods makers.
So, sorry, just so I can clarify, consumer discretionary is an area you're wary of.
So consumer staples is an area
I'm sorry. Oh, yeah. Okay. Carry on, please.
Yeah, and discretionary is an area that I think you have to be really specific about the risk you're going to take, because it encompasses a lot of different areas. You've got Home Depots, Lowe's, but you also have companies that more cater to luxury goods or have a very special case or branding behind them. So you want to be very particular. To me, and what I encourage our investors to look into is really trying to lean into durable, long-term growth themes. And I think a lot of that sits around the build-out of artificial intelligence. Mm-hmm. And I think that's where you have the most visibility into earnings growth going forward.
President Trump obviously wants a radical reordering of American industry. He wants factories put back into the United States. There is skepticism that these factories could ever be competitive. Do you think the U.S. economy will look very different in, say, 5 years or 10 years' time?
Yeah, it's hard to tell sometimes because things move so radically on a daily basis with respect to how the economic reordering is actually happening. I think the economy is going to look different based on how we've seen things evolve just in this first year. But it's really hard to extrapolate how far that can continue because, again, the dependency on trade between nations is still going to be there. The integration of supply chains across the world is still going to be there. And I don't think that's something a lot of management teams want to completely shift away from either. So I think there's going to be areas that are different. I think you are going to see a little bit more reshoring, not just in the US, but across a lot of the major economies of the world. But I don't expect to see a radical change with respect to countries still trading with one another and trying to find relative advantages with respect to trade.
We'd better jump. Matt, thank you very much for getting the week started. Really appreciate it.
Thank you.
Matt Orton, Chief Market Strategist at Raymond James Investment Management.